Join us for this latest quarterly update where I'm joined by Dr Scott Osborne, our Chief Investment Officer, to discuss Labour's budget, the US election, the market reaction to both, and what we've done in the VT Astute funds. Hello and welcome to the quarterly market update for Q4 2024. I'm Hannah Kennedy and I'm joined by Dr Scott Osborne to talk to you about the latest happenings of the last quarter and what we expect to see going forward. Scott, there are a couple of big topics that I want to cover with you in this update, and I'm sure you will know exactly what they'll be. Yep. Let's start first with Labour's budget. So we have other videos out there that clients can watch that will cover the headlines, sure. But from a market point of view, can you cover the market reaction? Yeah, so just zoning in on markets, there's a few key areas obviously that the budget could have had an effect and has had effects. So looking at them each in turn. The first area really is equities, and here there wasn't that much worry, but they could have changed some rules that really would have kind of been a bit of a rug pull for certain parts of the equity market, particularly what we call the alternative investment market AIM, which is interlinked with inheritance tax rules. And whilst they did tweak the rules there, they didn't do anything that really kind of torpedoed everything. So it may struggle a little bit more in future than it otherwise would have done, but there certainly wasn't any sort of hand grenade thrown in that area or anything. So that was kind of okay. And combined with the more general kind of growth tone and fiscal stimulus that we now know was basically coming in the budget, it was generally quite a positive budget for equities generally, because there's probably going to be more government spending. The other big area, and probably the one that most people were watching more closely, was gilt. So government, UK government bonds. Obviously with the Liz Truss episode, there was this fear that if Labour kind of weren't sensible with the money, you might then see this big spike in gilts again, and that really wasn't the case. Obviously they had the Office of Budget Responsibility on board, which Liz Truss didn't. They are committed to a balanced budget. They've changed the fiscal rules a little bit, but actually most people think the change is a sensible one. So whilst they've kind of rigged the game a little bit to give themselves a bit more spending, and obviously you'll know from the other videos that they are spending quite a lot more money, the market wasn't massively concerned that they're suddenly writing blank checks left, right and centre. Having said that, we did see gilt yields, so the cost of government borrowing, increase maybe 15 to 20 basis points just purely off the budget. It's hard to zone in exactly on the impact because obviously we have all this stuff going on in the US at the same time, but all else equal, it feels like there's going to be more spending than there otherwise would have been. That will put more upwards pressure on inflation. The OBR said that, the Bank of England said that yesterday. And so probably interest rates come down more slowly than they otherwise did. Big guess, but probably. And if that's true, well then gilt yields should be higher because obviously interest rates aren't going to come down so quick. So all in all, it was kind of, the banana peels were kind of dodged, I think, which leaves us feeling pretty positive generally about the UK economy. As we've said in the past, as a stable government and sensible fiscal policy, it should start to look slightly more attractive as an area of investment in future, we think. Okay, great, thank you. So that covers how the markets reacted. What did we do in the funds on the back of this? Yeah, obviously that leads naturally to us. I think we have been for some time trying to build a more positive story around the UK, and it was basically the budget that was holding off, not necessarily because of the banana peels, but we just wanted to see how committed was the Labour government to actually generating some growth, because that's really what's needed to kind of fire up some of the mid caps, particularly in the UK, we think. And as I kind of alluded to there, we think it was quite positive in that regard. So we are thinking of getting a bit more positive in the UK. We're just looking at the right sort of vehicles to do that. Again, as we'll probably talk about in the US, we see the right part of the market for this as down cap, as we say, so smaller size companies, a bit more domestically focused, a bit more able to benefit from that additional consumer spend or additional government spend that's going to come through from this fiscal stimulus. The government's got a big capital spending commitment, but it's also just allowing a bit more spending in all of its departments. That does put a bit of strain on the finances, but it also just allows a bit more money to flow through the economy, and really we'll be looking for the areas that will see benefit most from that. So we think probably in the near future we might rejig our UK exposure a little bit, maybe increase it in absolute terms, or maybe just kind of refocus it to be a bit more specific in certain areas. But that's probably the big change from the budget, and in all honesty we were kind of waiting to do that. We've wanted to do that for some time post the kind of political developments in Europe where things continue to get more uncertain, obviously massive uncertainty in the US. A stable and fiscally credible government in the UK had us kind of wanting to put assets there, and now we think
some of the, like I say, banana peels have been navigated, we can start to look to actually allocate that capital. So that's probably the trade or change on the portfolios that will come in the next few months.
Brilliant, thanks Scott. Let's move away from the UK now and let's look at the US with the election results coming through so quickly this week. Can you touch on everything that's happened over there in the US over the last couple of days and our portfolio response to this?
Yeah, I mean, I probably can't talk about everything that's happened in the US. It feels like a lot. I'd say a few very high-level points on the market, and then I'll dive into our portfolio position and maybe some changes we make. Obviously, but probably one of the good things about this election was that it was resolved very quickly, right? There was lots of paths for this to be very difficult. Popular vote, electoral college, all the stuff we talked about in our US election video. But basically, Trump won. He won in quite a significant way, and he also won the popular vote. So the Democrats can't even really complain about the system anymore. It was a pretty straightforward deal. The other thing to say is that he almost certainly is going to sweep Congress. So he's going to take the House. They definitely already got the Senate. So he will be able to enact some of his domestic policies, which otherwise might have had some opposition from Democrats in the House. That's still not actually 100% decided, but it seems almost certain. So that then puts us in that red sweep scenario, which we talked about, and it's like, okay, Trump's rhetoric is basically cut taxes in lots and lots of places, put tariffs on external goods coming into the US, and kind of tackle immigration one way or another. He's talked a lot about deporting immigrants. Now, explicitly, these are considered, or a combination of these policies is considered inflationary, right? You're going to push money back into the economy by reducing taxes. You're going to leave more money in people's pockets to spend. You're going to basically raise prices by putting tariffs on. Again, you can debate and discuss how that impacts, but almost certainly you will. And then you're going to reduce the labour market because you're going to send off loads of the actual people who are doing these jobs and keeping wages down out of the country. That's going to push wages up. And that's kind of been the initial market reaction. Some of it's unwound a little bit, but that's basically what people worry about, is that there's more inflation coming down the line. Now, we did also have US Federal Reserve, so the central bank meeting in the US yesterday, as well as the Bank of England meeting. So we know now what the US Federal Reserve's opinion is, and they're basically saying they're not going to do anything on rates until they know what the policies are. And that's kind of what the markets has come around to, because no one really knows what Trump is going to do. Here's what he said. Is that an opening position? Was it just to get him elected? Is it, truly what he believes? Is he going to put people in and around him in his administration that absolutely enact this to the letter of the law? We just don't know. So I think the main story at the market level is that it's going to be very uncertain, and we're basically going to have to roll with the punches and react to things. We know probably the direction of travel, and we're positioned for that, but we don't know the exact specifics, and as those specifics come out, we'll probably have to reposition around them. Having said that, we have been for some time overweight mid and small in the US. And they were the biggest beneficiary, because at the very high level, one of the super policies for Trump is tax cuts, and that will almost certainly come. And mid and small companies benefit more from tax cuts because their marginal tax rate is the domestic one. The big, global conglomerates, they basically pay all sorts of tax and loopholes, etc. So the tax rate tends to actually be lower. And we're very kind of already exposed to that theme, because we have, half of our US positioning is basically is away from the S&P 500. Or what we actually do is, rather than invest in the S&P 500 as you know it, we invest in what's called an equal weighted version, which has more mid and small companies in it. So that was one of the areas that did very well. We also have some US small cap companies which did well. One of the things we'll probably look at in future and kind of looking forward, do we need to respond to, is the balance between emerging markets and US. We're currently overweight EM versus our benchmarks and underweight US versus our benchmarks. We have a lot more US than emerging markets, don't get me wrong, but that balance. So we'll be watching that closely. But that's probably the big take home from the US election, is we're going to have to be on our toes. There's going to be more volatility, and a few key areas we're looking at in detail that we might want to respond to again in the next few months, in the kind of immediate aftermath.
Brilliant. One thing I noticed that you mentioned there then was equal weighted versus market cap weighted. Now, if clients were perhaps to look at their funds and the holdings within them, the names might appear quite similar, but of course they're quite different. Can you explain the mechanics behind equal weighted and market cap weighted?
Yeah, okay, yeah, sorry, there's a bit of jargon there really, isn't there? But if in very simple terms, if you think about most indices, they're what's called market cap weighted, and all that means is that the biggest companies have the biggest share, right? Because The market cap is just the share price value multiplied by the number of shares in issue, and that gives you how big a company is. The biggest company is then the biggest component of that index. So in the S&P 500, Apple, I think probably today just about, is still the biggest company. It will be something like 7% of that index. If you buy an S&P 500 tracker, you get 7% of Apple. And that's what we call market cap weighted. And it's kind of the traditional way of doing things. You basically get more of the bigger companies. The bigger companies tend to be the better ones, and they do well, right? As companies do well, the share price goes up and they get bigger, they go up the market cap, and you get more of them. That's just how it works. And in the S&P particularly, it's quite concentrated now. We talk about the concentration risk because the biggest companies are much bigger than all the other companies. It's true elsewhere. In fact, the top 5 companies in the FTSE 100 are over 30% of the FTSE 100, whereas it's more like 28% in the S&P 500. But one of the ways of getting around those risks, i.e. that concentration risk, is kind of throwing market caps out the window and just saying, okay, well, we've got 500 companies in the S&P 500. Let's just allocate to them equally. Let's give them all the same share. It doesn't matter how big the company is or how good it is or whatever. We just want the same amount in every company, and we'll rebalance that on a regular basis. And the idea behind that is that basically, rather than have company-specific risk, so Apple risk, Apple earnings will have a big impact on the S&P 500. You're really kind of trying to broaden your exposure out to just be more exposed to growth, to just the economy. And that's our thinking behind this equal weight position, and kind of reducing our S&P 500 market cap sizing and putting that money to work in the equal weight is spreading that capital around more companies and hopefully trying to get a better capture of underlying growth as and when that growth broadens out in the US economy, and also avoiding some of the concentration risk potentially around stretched valuations at the top. But yeah, hopefully that's a quick explainer on this whole market cap versus equal weight type scenario.
Brilliant, thank you. So a lot of the big events that we were looking forward to happening in 2024 have now happened. So from a client point of view, should we touch on our long-term views? Have these changed? Yeah,
I mean, probably a little bit. Both the budget and the US election have probably increased inflation risk a little bit more in the medium term. Obviously, Labour is spending a little bit more money than we expected. We don't know what Trump's going to do, but as discussed, he's probably inflationary. So we have to be a little bit more cautious around that than we otherwise would have done. There is potential for a bit more boom and bust under Trump in the US. So we have to be a bit cautious about that as well. It's the kind of like, if the music's still playing, then you're still at the party, but at some point someone might switch it off. That bond vigilante risk that we've talked about in the past, the idea that the market just kind of gets fed up with government spending too much money and starts to ask for more back, that's still kind of hovering. So I wouldn't say necessarily that our long-term views have changed massively. We still expect interest rates to come down at a pretty good clip into next year, but then there almost certainly will be more of a pause and a change in trajectory depending on how policy develops. And we'll have to respond to that. So I guess probably just a kind of re-emphasis of the risks that we see out there, rather than a real shift in our long-term views. We're still generally pretty positive on growth and interest rates coming down, but a little bit more worried at the margins about that inflation risk. And then whilst a lot of the big political risks have now gone, i.e. the US election being a big one, they are still rolling around. Europe, the German coalition just collapsed this week. Who knows what's going to happen there, and all these different global governments have to respond to this new Trump administration. So whilst it was a big year for politics, I don't think that's going to go away. For the next 4 years, Trump's going to be a big character. The personal interactions between leaders and Trump is going to matter, and we're going to see how that kind of develops over the next few years as well. So yeah, no massive changes. We're probably going to have to be on our toes a little bit more, probably a few more late nights in the office, responding to things. But yeah, that's kind of our job, and that's why we're always there to kind of respond to things as and when they happen.
Brilliant. Thank you, Scott. And thank you for listening. If you've got any questions, then please get in touch with your financial planner, and we'll see you next time.